So what are your thoughts about the current real estate market? Are you fearful? Are you being greedy? I want to discuss today the ways I think you can be neither and still achieve your investing goals. You know, the stock market is more volatile than ever. The interest rates are rising, inflation is raging, and where are we supposed to basically place our investment dollars in environments like this? You know, Warren Buffett famously said, be greedy when others are fearful and be fearful when others are greedy. Personally, I'd rather not be greedy or fearful when I'm investing. Full disclosure, I think most people know this by now that have been watching me, but I invest in hard assets in inflationary times, in deflationary times, and really all times. One of my favorite hard assets is real estate. And I've lived through enough cycles to where the only thing that changes during economic times really is the subclass of real estate that I invest in. Now, I still believe real estate is the place to be. You know, I think technical recessions don't last forever. The vast majority last less than 18 months. And recessions are the perfect time to start a project that'll be delivering in 36 to 48 months, which will be right in the middle of an economic recovery. You know, this really affords the opportunity to take advantage of lower construction prices, lower economic labor costs, while really gaining the advantage of exiting in a recovering market. So real estate development deals can be a great place to invest capital right now. But, you know, a lot of people ask me also, what about value add? And, you know, with increasing interest rates and mezzanine and bridge debt, increasing as well, those rates, the value add multifamily operators, it becomes a little more expensive to do these, and that market for lending has either become very expensive or dried up completely, and then more equity is required from these operators to squeeze comparatively lesser returns out of these endeavors. So I'm sure there are good opportunities out there, but the number is definitely going to be fewer and harder to find. So I usually don't invest in heavy value add opportunities in these environments. I do look for development deals during these times, however. And look, we need to understand the average historical interest rate increase, the time interest rates increase is 21 months on average, with the longest being 36 months, and that's dating back 40 years. The average total interest rate hike by the federal government during the same time period is about 3%, with the highest in the last 40 years being 4.25%. Now, considering the Fed has already assaulted our economy over the past 6 months by raising interest rates by 3% as of this writing, you know, with this trajectory, it seems pretty reasonable to expect rates to plateau in probably early 2023 and potentially even start to fall again by the end of 2023. So delivering a Class A multifamily asset in 2024, 2025 is really just sound planning because history tells us at that time interest rates will be on the way down and the economy should be in recovery mode. You know, additionally, we're already seeing a 25% decline in multifamily construction as well. And, you know, we're going into this recession underbuilt, and I'll discuss that a little bit later. But being underbuilt already, you can imagine the supply hole in 2.5 years as new housing starts have cooled. There's going to be a lack of improved value add for reasons I mentioned earlier. And this is going to lead to a supply-demand mismatch that really could be profound. So you're looking at lowering or low interest rates and high demand. Does that sound familiar? That sounds a lot like the last 7 years that we've just gone through. So yeah, I do like development deals. Another area I like to invest is manufactured housing communities and RV parks. I think we've established several times in my past writings at least, and if you want to look at that, you can go to my website at thecashflowmd.com and click on my blogs. I've wrote several times about manufactured housing communities and RV parks, and that they are excellent cash flowing assets to really consider during any time, but especially these times. You know, as inflation rises rapidly, consumers are the ones that bear the cost for pretty much everything, including housing and vacationing. However, you know, those that own the real estate assets can react quickly to these prices and mitigate the effects of inflation. So RV parks and mobile home communities and manufactured housing community owners can really respond quickly to changing economic environments by adjusting their prices for both site rental and lot rental accordingly. And manufactured housing communities tend to stay very full during all cycles of the economy. The good parks that they generally have excellent operators, and tenants want to be a part of these communities because they add value to them. They improve the infrastructure, they enforce community rules, they encourage tenant engagement, have tenant community events, those types of things that really breed ownership and satisfaction in these communities. RV parks are an excellent low-cost way for families to get away and still have a vacation in uncertain economic times. Now, parks with cabins and other form of lodging for rent are especially enticing because really the vacationer doesn't need an RV at all to enjoy the beauty of the outdoors and to get out and really experience this with their family. Housing's evergreen. People are going to continue to vacation in all economies. During inflationary times, I think manufactured housing communities and RV parks are really two low-cost options for housing and vacationing respectively, which makes them a nice target for savvy investors. So back to what Warren Buffett said, right? Maybe it is time to be a little bit greedy, because when the economy takes a pause, we tend to recall the most recent recession, right? And assume we're in for a familiar or similar experience. Now, it's important to be cautious and really be students of history here, because just like with our investments, it's really important that we continue to do proper due diligence on the factors that are causing this economic pause. So the underlying factors are not nearly the same as they were previously. In the late 2000s, we were overbuilt by conservatively 3 million housing units. Lenders were giving loans to people that had no income, no job, and no assets. They were called ninja loans. And the resultant bubble just absolutely popped and rocked our economy. Now, still during that time, average rents increased every year, with the exception of 1 year where rents dropped less than 2% in the single family housing market only. Now, then they continued their upward climb, just like all other sectors continued their upward climb in the past 10 years for rental income. Obviously, there were a ton of governmental financial gymnastics that occurred during this time, but the point is, if you owned hard assets at that time, now owning means just that, by the way. If you were one of those that had 105% leverage on your home, you had a 2-year ARM that came due when rates skyrocketed, then I would contend that you never owned that home in the first place, right? But if you did have assets, you came out of that unscathed, and if you kept those assets, you participated in one of the greatest accelerations of real estate wealth the U.S. has ever seen. That was with an oversupply of housing. We're currently underbuilt by millions of homes in all the single family space, the affordable housing space, the apartment space. All of that is still underbuilt heading into this recession. So I like that situation much better than in 2010. And, while there is likely to be a correction in the real estate market, I view this as an opportunity, not a threat. I believe it's going to be transient, and we're going to rebound as interest rates stabilize. And then they're going to fall again, because that's what history tells us. In the midst of the pain that we're going through in recessions, it's sometimes difficult to look into futures. And in these times, that's when I lean on historical markets for real estate. Everybody thought it was the end of real estate in 2010 and 2011. But several who invested well came out of that last recession in a much, much better financial position. I took note of that and feel like this may be an opportunity for us to do the same. And so maybe just a little greed isn't so bad. Thanks, Mr. Buffett. And I will say, as a disclaimer here, if you think that interest rates are going to continue to rise for 3 years, like continue to go up, 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 and up, it really makes sense to buy absolutely nothing in real estate right now. Not single family, not multifamily, not commercial, not industrial, nothing, because nothing will work. And if you believe that, then we're just going to have to agree to disagree at this time. But no investments are bulletproof. I highly suggest doing your due diligence on any opportunities that you're considering. My intent here is just to share what I'm investing in currently and why I'm doing it. Finding a coach, a mentor, an investment group is always, always, always advisable. And really, it propelled my investing acumen and results dramatically and very quickly. If you're interested in learning more about these investments or any other investments and want to talk to me about it, feel free to reach out to me on my website, thecashflowmd.com. But until then, here's to winning your time back.